We're just going to do a walkthrough of the partnership taxation extra problem that's found on Canvas. While we're walking through this, I'm going to discuss a few of the concepts of partnerships and some of the rules that you might need to remember as you think about how partnerships work. So first of all, there's the basic premise that everything is taxable unless there's a specific rule that says it's not, and it's taxable right now unless there's a specific rule that allows us to delay that. So understanding why a rule would allow us to delay or exclude something for taxation might help you as you think about the partnership rules. Also remember that nothing is deductible unless there's a specific rule that says it is. And so with that in mind, why do we have partnership rules? Well, partnership rules came about because we want to be able to keep track of the activities that happen in certain business environments where there's not a tax-paying entity. So we'll call a partnership a taxpayer, but it doesn't actually pay income taxes. It's just going to file an information return. It's going to tell us what happened with our share of the partnership or which partnership items are allocated or allocable to us as partners. It will also inform the IRS how the partnership chose to treat specific items and which partners were allocated items of income and deduction so that the IRS can also keep track of things. Now, one of the first things we talked about was outside basis. Outside basis is the partner's basis in their ownership interest. This is a lot like a shareholder buying stock. When I buy stock in Walmart for $100, my basis in that stock is $100. The only reason anybody cares about that basis number is because that is the number we're going to use to calculate whether I have a gain or a loss. Similarly, the only reason we care about how long I've held that basis or ownership interest is because we're going to decide whether it's a long-term capital gain, which for an individual is taxed at preferential rates, or whether it's a short-term capital gain, which would be taxed at ordinary income rates. So with that in mind, let's look at what happened with this partnership example. Emily and James formed EJ LLC, which is taxed as a partnership, on January 1st of year one. Emily contributed $100,000 of cash, so that's in cell D3, and James contributed land. The land's fair market value was $190,000. The tax basis that James had in the property was $110,000, and there was a $90,000 liability which was assumed by the partnership. So the first thing we want to do then is we want to say, okay, what is going to show up on the partnership's balance sheet? Often faced when they're talking about partnership basis allocations and balance sheet items is this idea of fairness. Is it really fair for a partner to contribute something with a basis of $110,000 and get relieved of a liability of $90,000 and still have a 50% partnership interest in the EJ partnership, for example? Well, let's remember that when we look at partnership contributions and in exchange for partnership interest, we're actually looking at the fair market value of those things. So even though for tax purposes we're going to account for them differently, for determining the share of a partnership, they're going to look at the fair market value of what they contributed. So I'm going to start with the book basis, which will give us a good idea of the fair market value that they contributed, and then we'll start looking at the tax basis and then the outside basis. The reason I like to start with balance sheets is remember that liabilities will affect potentially all of the partners' outside basis in their ownership interest, even if they didn't have anything to do with that liability when it was contributed. So first we're going to look at the book basis balance sheet, which is all fair market value. $100,000 from the cash that Emily contributed. The land is valued at $190,000. So we have assets of $290,000. We have a liability of $90,000. That means that we have left Emily's capital account and James's capital account. And we know that the balance of these two, or the total of these two, will be $200,000. Well, Emily gets $100,000 for her $100,000 of contribution. James's capital account then is calculated by the fair market value of what he contributed, the land of $190,000 minus the $90,000 liability that land was subject to. He gave the partnership a net fair market value of $100,000 worth of assets. So you'll see that if we look at the book balance sheet capital accounts, they each have $100,000. It seems pretty intuitive then that they're each going to have 50% of the ownership in the partnership. Now let's look at the tax basis balance sheet. Cash is going to come over at a carryover basis, and Emily's basis in her cash is always the same as the amount of cash, so $100,000. Land is also going to have a carryover basis. The basis in James's hand was $110,000. So that gives us total assets of $210,000. The liability is recorded at fair market value, just the amount of the liability, so that's $90,000. Emily's capital account will again reflect the tax basis of what she contributed minus any liability that she contributed, so $100,000 again goes to Emily. And James's capital account then is going to be the difference between that $210,000 and the $190,000. This is calculated based on the carryover basis of the land that he contributed, $110,000, minus the $90,000 of liability that was attached to that land. So James's capital account will be $20,000 for tax purposes. Now there may be a question about why the capital accounts really matter. They matter when it comes time to distribute things. And we're going to talk about that next year, basically. For right now, you don't have to stress too much about that. I just want you to focus on understanding what happens for the book basis in terms of fair market value and the carryover basis that affects the tax balance sheet. Okay, now we're going to calculate the beginning of year outside basis. So this is going to be based solely on the tax balance sheet. Well, Emily starts with $100,000 of cash, or her basis in the cash that she contributed. James did not contribute any cash, but he did contribute $110,000 of land. Okay. Now, Emily's share of the liability, if we look at the partnership tax balance sheet, there's $90,000 of liability. So Emily's share of that liability is half. So she gets an increase in her basis of $45,000. James also gets an increase in his basis of $45,000. Let's look at debt relief. For debt relief, James was relieved of $90,000 of debt. Now, why is it that we did the $45,000 addition before we did the $90,000 of debt relief for James? Well, the answer to that is that we always do positive items first, and then we do negative items. Now, granted, it's very clear that that positive item of $45,000 of his share of the liabilities of the partnership came because of the negative $90,000 that he contributed. And that's okay. But first we're going to do the positive items, then we're going to do the negative items. And so that's one of the reasons I really like to do the tax basis balance sheet first and then look at the outside basis, because we already know how much that liability is and how much is going to be allocated to each partner. Okay. Now we're going to look at what happened during the year. During year one, EJ purchased $25,000 worth of municipal bonds, paid off $50,000 of the loan on the land, and for the year, they reported $100,000 of gross business revenue, $70,000 of other business expenses, and $10,000 of guaranteed payment, which was not included in the original $70,000 number. They also had $5,000 of charitable contributions and $2,000 of non-taxable municipal bond interest. At the end of the year, they made distributions to Emily and James of $10,000 each. So I'm going to go down here to the middle of the page, and we're going to talk about exactly how we would report these things to the partners and on the partnership return. So on page 1 of the 1065, the partnership return would report the revenue for the year, $100,000. It would also report the expenses of $70,000, and it would report the guaranteed payment of $10,000 to James. That gives us total net business income of $20,000. They also have some separately stated items. So if you look at the separately stated items, what are we talking about? Well, one, we're going to report the guaranteed payment of $10,000 to James. That will only be reported on James's K1. Charitable contributions of $5,000. That will be reported half to each of the partners, Emily and James. And we have some tax-exempt income of $2,000 that will also be reported half to each of the partners. Now you'll notice that there's no total here underneath the tax-exempt, charitable, and guaranteed payments. These separately stated items we just state separately. These show up on the K1 and are reported separately. Business income of $20,000 would show up on line 1 of the K1 in that box 1. Everything else will show up below that and will be separately stated so that each taxpayer can account for it in their own way and for their own taxable situation. For example, if Emily itemizes deductions but James does not, Emily will report $2,500 of charitable contributions, her 50% share of what the partnership spent in charitable contributions, and James will just report nothing on his tax return because he does not itemize deductions. We'll talk about that more in test 3, but for now, understand that separately stated items are there because they may be treated differently at the partner level. So first we report ordinary business activity. Revenues, expenses, guaranteed payments are also an expense for partnerships, and then we report everything separately. So let's take a brief look at how these items, and I'm also going to put in distribution for Emily, or to Emily, and distribution to James here. These will be reported on a different box in each person's K1. Okay, so we've got the distributions to James and Emily. Well, let's take a look really quick at how all of this is going to affect their outside basis. Remember, our beginning of the year outside basis for Emily was $145,000 and for James it was $65,000. So first, we're going to look at each of the partners' share of their business income, so $10,000 each. We have non-taxable income, tax-exempt income of $1,000 each. Then we have a couple of things that are going to affect their outside basis negatively. Now remember, we always start with the positive things, then we get to the negative things. So distributions would be $10,000 each. Debt relief, they're going to have $50,000 total of debt relief, so that's $25,000 is allocable to each of the partners. And charitable contributions, there were $5,000 of charitable contributions in total, $2,500 per partner. So that gives us an outside basis, which is equal to our initial basis plus the sum of all of the things that happened during the year. So we have $118,500 for Emily and $38,500 for James. So now we can see that the end of year outside basis for Emily is $118,500 and for James it's $38,500. We'll talk a bit about what that means in just a second, but for right now I want to go back to this ordinary business income that we calculated earlier. What is the significance of reporting this $20,000 of business income? Well, for partners first, that will be included in their ordinary income, and that will help determine whether they have taxable income for the year on their individual tax returns. In addition, for partners who are individuals, who are filing a 1040, business income is subject to self-employment tax. This is a big deal for partnerships because all of the flow-through income that's ordinary business income is going to be subject to self-employment tax. Partnerships are, for that reason, disadvantaged compared to, for example, S corporations, where the ordinary income that flows through from an S corporation is not subject to self-employment tax. So Emily is going to have $10,000 of income that is subject to self-employment tax. James, on the other hand, is actually going to have $20,000 of income that's subject to self-employment tax. It will be the $10,000 of his ordinary business income, half of this $20,000 number, plus his guaranteed payment of $10,000. Both of those amounts, the entire $20,000, is subject to self-employment tax for James. Now let's talk about this basis and why it's such a big deal. Why do we even care what our outside basis is? Well, if you'll notice, the outside basis went up for each partner for the $10,000 of the ordinary business income that they received, or that was allocable to them. They also each received a $10,000 distribution. Essentially, they received a distribution equal to the business income for the year. Now that's coincidental this time. It's not always going to be the case that happens. What happens though, and we're just going to look at this as a just what if situation. What happens if James received a distribution of $80,000? And we'll say that both James and Emily received a distribution of $80,000 this year. Well, you'll note that Emily still has $48,500 of outside basis, so that distribution is not taxable to her. That is, in fact, just a return of her original investment of $100,000. It's just a return of part of that. James, on the other hand, will now have a basis of negative $31,500. Now, we know we can't have a negative partnership basis, so what do? Well, James would go back up into his calculation of outside basis, and he would actually recognize a gain of $31,500. That gain, if you'll notice over here on our outside basis calculation, gain recognized, that gain is $31,500. That's going to be treated as a capital gain. The next question is that capital gain long-term or short-term? Because the capital gain is coming to James, is related to his partnership basis, we're going to look at long-term in one of two ways. First, we're going to say, did he hold his partnership interest for more than a year? If he did, hey, we're already done. We don't have to stress about it. We move on. If he didn't, we also look at his holding period of the asset that he contributed. James contributed land with a fair market value of 190, basis of 110. The actual basis isn't important in this case. It's just important that he contributed land. But what is important is whether that asset was a 1231 asset. So a 1231 asset, if you remember, is an asset that has been held for more than 1 year and was used in a trade or business during that time. If that is true, if that land is a 1231 asset, then James's holding period tacks on. Now when we say tax on, that's T-A-C-K-S, thumbtack, okay? We're adding the holding period of his land to the holding period of his partnership interest. And the holding period of his partnership interest then starts as if it had started. We calculate as if it had started on the day that he owned that land before. In this case, if a 1231 asset is contributed, we know for sure that it's been held for at least 1 year. So this gain, this capital gain of $31,500 that he'll recognize is a long-term capital gain. And that's important because James is an individual and long-term capital gains are taxed at preferential rates. So let's go back and just delete this. We're going to go back to the example we were talking about before when the distribution was $10,000 each. Let's talk about the cash consequences of what the partnership did this year. They had a beginning of the year balance of $100,000. They purchased a municipal bond for $25,000. They had a loan pay down of $50,000. They had business income, including the guaranteed payment to James, of $20,000 total. They had charitable contributions of $5,000. They had tax-exempt income of $2,000. And they had distributions of $20,000. So that gives them an end-of-year balance of $22,000. So let's look at the partnership books for book purposes at the end of the year. We know their cash balance is going to be $22,000. They now own $25,000 worth of bonds. They still have the land at $190,000 because land does not depreciate. The liability, on the other hand, was $50,000 of that was paid off, so now they have a liability of $40,000. Emily's capital account is equal to her original capital account of $100,000 minus all of the things that happen that would reduce her capital account and adding anything that does not reduce her capital account. So let's look at all of the things that affected Emily's capital account during the year. She started off with a capital account of $100,000. We add to that her share of the business income of $10,000. We add to that the non-taxable income of $1,000. So now her outside basis, or her capital account would be $11,000 minus the distribution of 10. It's back down to 1. We ignore the debt relief, that's already taken care of in our liability section, and we look at the charitable contributions of her share of that was $2,500. So we have a $1,500 reduction in her capital account. So her new capital account is $98,500. That is going to be the same for James. He's going to have those same things that affected his capital account. Business income of $10,000, non-taxable income of $1,000, distribution of $10,000, and $2,500 of charitable contribution. A natural question that may arise is what happens with that guaranteed payment? Well, that's an increase in income to him and also a distribution to him, so that just nets out to 0. So for the book balance sheet, we're starting with the fair market value of everything that happened. Now, what about the cash balance sheet? Well, the fair market value, or the basis in the cash, was the same as its fair market value. We're still going to have $22,000 of cash at the end of the year. Bonds, we purchased them, so our basis is just what we paid for them. Partnership purchased them at $25,000. That's how they show up on the books. Land, again, has a carryover basis of that $110,000. Nothing has changed there. So we have a total assets of $157,000 for tax purposes. We still have $40,000 in liability for tax purposes. And now we're going to look at the capital account again and say what happened to each of their respective capital accounts. So we know Emily's capital account went down by $1,500. So her capital account, which at the beginning of the year for tax purposes was $100,000, will remain at $98,500, the same as it is for book purposes. James's capital account for tax purposes was $20,000. We're going to take off the $1,500 for him. His capital account is $18,500. Now, one thing to make sure you do is look at the assets and the capital and liability sections and make sure that those balance. That's why it's called a balance sheet. Okay, now we've correctly accounted for everything that happened during the year. I'm going to go back now and briefly walk through the answers to the questions that were in the extra problem. So number 1, part A, is what is EJ's inside basis in each of its assets? Well, we just look at the tax balance sheet at the beginning of the year. It's $100,000 for cash, and it's $110,000 for the land. So again, just to reiterate, the inside basis of any asset is just the tax basis on the balance sheet for the partnership. So what is Emily's outside basis in her partnership interest? Well, her outside basis is the $100,000 of cash that she contributed plus the $45,000 of liability relief, of the liability that the partnership has that's now her share of that. So her outside basis is $145,000. What's her book capital account balance and what is her tax capital account balance? Well, her book capital account balance and her tax capital account balance both reflect the fair market value of the $100,000 of cash that she contributed and the carryover basis in the $100,000 that she contributed. What's James's outside basis in his partnership interest? Well, it starts with the $110,000 of carryover basis for the land that he contributed. We add $45,000, which is his share of the partnership debt, and we take away $90,000, which is the debt that he was relieved of when he contributed the land. So his outside basis is $65,000. What's his book capital account? It's going to be equal to the fair market value of what he contributed. The net fair market value of that is $190,000 for the land minus $90,000 for the liability. His book capital account will say $100,000. His tax capital account will be a carryover basis of the land, $110,000, minus the $90,000 of liability. So his tax capital account will be $20,000. Now, number 2 asks us to look at the end of year 1. So what's EJ's inside basis in each of its assets? Cash, $22,000. Bonds, $25,000. Land, $110,000. So we're looking at the tax side of the balance sheet for the end of the year. What's Emily's outside basis in her partnership interest? We start with the 145, which is the beginning of the year. That's what BOY means, beginning of year. End of year is EOY. So beginning of year, $145,000. We add her allocable share of the business income of $10,000. We add non-taxable income or tax-exempt items of $1,000. We have distributions of $10,000, so that's a subtraction. We look at her debt relief of $25,000. That's a deemed cash distribution. And then we look at the charitable contributions of $2,500. And we come to a total balance for her outside basis at the end of the year of $118,500. And I just noticed over here that the deemed distribution part of this decreases was actually hidden, so I reformatted that really quickly. So we've got, again for James, we start with $65,000. We have his share of $10,000 of business income, non-taxable income of $1,000, distributions of $10,000, debt relief of $25,000, and charitable contribution of $2,500, and that will give him an outside basis at the end of the year of $38,500. Part D says, what is Emily's book capital account and what is her tax capital account on the balance sheet? So we look at the end of the year. Emily's capital account, again, is $98,500, and we've already walked through how we got to that calculation. We look at her tax basis, it's the same. So it's the $100,000 of original basis minus the net $1,500 of changes, and you can look at the increases and decreases over here on the very far left of the spreadsheet if you need any help with that reference. And so hers is going to be $98,500 for both book and tax because, again, the tax basis in what she contributed and the fair market value of what she contributed were the same. For James, the fair market value of what he contributed, the net fair market value was $100,000 minus the $1,500 that represents his net change in capital account over the year. So $98,500 for book purposes, and his tax capital account was $20,000 at the beginning of the year minus the $1,500 of changes, gives him $18,500 as a capital account at the end of the year for tax purposes. Now, E says, what is James's outside basis in his partnership interest? Again, we start with the $65,000 of beginning of the year, add his business income and tax-exempt income of $11,000, take out the distribution of $10,000, take away the debt relief of $25,000, which again, we look over here in column A is a deemed distribution, and we take away the charitable contributions of $2,500, and we get to $38,500 for James. So what income loss items flow through to James for the year? So we've already kind of reconciled this, part F. Again, it's his share of the $20,000 of business income, his guaranteed payment, he's the only one that receives that. The charitable contributions is split in half, $2,500. Tax exempt income, he gets half of that for $1,000, and he gets a distribution of $10,000. So part G, what is James's book capital account balance and his tax capital account balance at the end of the year? We've already discussed that. Let me know if you have any questions, or let your tax professor know if you have any questions, and we will see you tomorrow.